Hello, folks. Welcome to State of the Market. I am David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Today is Monday, September 22nd, 2025. Hope everyone's having a great day. So, in this webinar, we look at some of the big indexes and things like that. Although this is what we call a stock pickers market, a low volatility, low correlation market, and things like indexes um, often give smaller moves, and individual names sometimes give more performance. So we're going to kind of hit on both those things and talk about some of the overall big things that are happening here, because we're really in a spot here which is kind of a classic wall of worry melt up. And I think that the thing is that the dollar is under pressure, and there's a lot of cash on the sidelines, and there's really not much else beyond that. So if we're on tradestation.com, go down to chips breakout as investors return to tech. That's the article that we're going to be, um, a lot of the information we're talking about was covered in this, but there's a lot more I wanted to say today. Some interesting things popping up like OpenAI and NVIDIA and things like that and what it says. Um, but first, I want to just kind of show this is what I call the volatility cycle. We've covered this at different times in our market trends webinar, and you're in a period right here where we're essentially on this part of the volatility cycle. If you can see my mouse, essentially, the key thing is that the VIX, once it starts falling, you can have a period when it just remains relatively unvolatile for a long time. And during that period, individual stock can move. The S&P has broken out to new highs. There's a lot of cash on the sidelines. There's some other interesting things happening. So in this environment, you get stock picking. Eventually, it has the risk of morphing into complacency, and then you start to get volatility and a crash. Things correlate, and then you get into an environment when the indexes make more sense over here. But we're over here in this part of the volatility cycle, and I think it's really important to realize that. Okay, so I also want to show you quickly before I forget. Let's go over here and show the standardized returns of some of these ETFs we're going to be talking about. Come on. Sometimes, there we go. You can just see these is my TradeStation platform. I'm going to turn it off because sometimes the streaming data, sometimes when I'm live streaming, I have a new computer now and it seems to be behaving better, but sometimes when it's sucking in all that data and I'm live streaming, it doesn't always work super well. So as that's working, as that's going, you can see these standardized returns. Before we even get to the individual sort of the big sectors, I wanted to very quickly actually, let me quickly start with this one thing here, which is essentially just looking at a few individual stocks. Like I said, stock pickers market, and I want to mention here that Advanced Micro Devices. Just to very quickly, just look at some of these names that people might be kind of aware of. You, I'm not sure exactly. You can draw a line off of this area, that high from the gap, or from here, but either way, it appears to kind of be basing out here with some potential for some continuation here. This got rejected at a pretty important weekly level back here, but that was like a long time ago now. That was like August 11th. It was a month and a half ago practically when this got rejected, and it's pulled back pretty well to hold this level from this gap back here in mid-July. So AMD here, these here's a low on 8th of September, same low on the 18th of September. So this is one that people might be looking at from a stock picker's perspective, might be interesting. Tesla continuing here, we had kind of just mentioned, I mean, from my perspective here, this is an area where it has, people probably see the space up to this level, but there was, I just wanted to mention today, the price target raised, citing robotics. So now people are starting to think more about Tesla as the robotic thing that's going to be coming. And I think it's important to realize is that this sort of AI, talk and the whole AI boom, it's not hard to see how it morphs from a chat bot to a real bot, like a robot. And I think increasingly as time moves on, that is where that will be part of the whole AI sort of narrative here. So Tesla here is just, I want to just point out that it had this upgrade, not an upgrade, it was a price target raised by Piper Sandler, but robotics, people are increasingly shifting from the EV focus to the robotics and the other sort of robo-taxi focus. So that's an important thing to realize at Tesla as it evolves from one kind of story to another. Now, there was a multiple notes on Apple about how it's doing better with the iPhones, and this is it's doing, if you look at this here, and this is in this kind of market, we keep seeing the bad news turn good. So, we were going to have this horrible thing in Google, and instead it was a good thing with the antitrust. We have these bullish stories come out of nowhere. And now, like Apple, after all this time of hitting our head against the wall, now suddenly Apple is starting to show traction, according to multiple analysts who we actually quote in this. We don't quote, but we cite them in this article: Wedbush, Morgan Stanley, TR, a whole bunch of these guys here. So that was one of the big things. So I wanted to just kind of mention that these positives coming off the kind of sidelines and something like Apple here. Another name that I did a trading view idea on just to kind of look at is Spotify. Interesting to see it kind of hold this kind of this breakout of this falling trend line. It's been in a longer term uptrend. It's kind of interesting. Another name is IBM is kind of filling this bearish gap that it had back here. This is one that people might find kind of interesting. It has kind of been evolving into a new kind of tech stock. Um, Emerging markets, the EEM, we don't normally cover this, but I want to just mention emerging markets are really in a spot now where people are starting to kind of pile into them. And when you look at them long term, they really haven't gone back to where they were, and not just in 2021, but these things are, a long term basing pattern going back like 15 years now. And, with the dollar where it is and valuations and all these other things, emerging markets are showing increasing outperformance. And I want to just kind of mention that. And then the other one that's kind of interesting I want to mention is IREN. They today said what were they doing? They were buying, I think they were buying a bunch of GPUs, which was interpreted as strong demand. It's a data center related name. These one of these names, we talk about this in market trends, but these names kind of pop up. You put them in your radar screen with the tools that we share in our zip file, and then when they pull back and have modest pullbacks, they light up and they tell you things. So I want to just point out these are some of the names that maybe here it is extended here, but maybe in a week or two, opportunities like this may reemerge when it comes back down. I don't have the 8-day exponential on this chart, but that would have tagged the 8-day exponential on that kind of pullback. And we have tools that we share that show us kind of how to find some of those things. So I want to mention overall that in some ways, like I said, this is like a kind of an almost perfect nirvana environment in some ways for risk appetite. And the reason is because we basically have a limping economy and earnings that are doing well. And that's kind of, you get the easy Fed, and you don't and you also get the potential for multiple expansion because of strong earnings and expectations for that. And we see all kinds of these deals popping up. So, for example, today, NVIDIA investing in OpenAI, that sort of relationship. We see a tie up between NVIDIA also and Intel, and there's been a bunch of other deals like that have been out there, and it just kind of shows that we're in a new environment for business, for deal making, and for things like that, and that is also something that can surprise to the upside. One of the things I emphasized in this article was we keep getting surprises to the upside. This stuff about sovereign technology investment. I think if the US government wants more chip production in the US, it's good for AMAT, it's good for Seagate. Today, Teradyne hitting a new high. TER is a chip equipment company. Just actually, it's a new 52-week high, not a new all-time high. But Lam Research has been rallying recently. So the thing with all these is that it's a broad sort of thing that is happening, and it's being driven. Part of the fact is that the news just keeps breaking in a positive direction, and the bearers and people who are not long get punished and are forced to chase. And the fact about that is that they're not ready to be selling. There's cash on the sidelines and news pop breaking in a positive direction. So it's also interesting. For example, here we kind of highlight some of those recently. Well, CrowdStrike, very briefly as mentioned, that had good, some good guidance. But if you look at things like the Oracle thing when it exploded and jumped on January 10th, I mean that was basically nobody expected a move like that. Not January 10th, September 10th. The Alphabet had the news on September 3rd. Apple basically has had this kind of incrementally positive news. It had this initial thing here, this spot in early August when they basically made peace with the Trump administration, and now they're running on the iPhones. So basically, you see these sort of things when the bad news just keeps morphing into good news with cash on the sidelines and the Fed not hiking at least. Who knows exactly what, how extensive the dovishness will be. The key thing is that there's cash on the sidelines and the macro environment remains accommodative as earnings surprises to the upside, and as the news, there's these catalysts surprise to the upside. All right, so I want to mention that right now, in my view, the most important thing is the dollar index. The dollar index at a 2.5 year low. I mean, it kind of squeezed off of it. We've been saying here that people may see potential for this to move down to 90 or lower. The dollar index here with the Fed being dovish, this could provide a very positive environment. for risk appetite overall, for stocks, but for other things as well. And that's one of the reasons why I mentioned emerging markets. So I think right now this is really a big thing. I think if you think about it as like a fraction, a ratio, the dollar is, look at something like gold, XAU, USD. The dollar is the denominator, right? So we all know from like, high school arithmetic that if you have a fraction and you make the denominator smaller, then the overall value of the expression gets bigger. So the thing is, the weaker the dollar gets, the more attractive risk appetite risk assets get on a relative basis, because dollar is safety. So if you kill safety, then kind of in a relational, if you diminish safety, then in a relational sort of equation, you naturally increase the value of risk. I mean, it's if you think about it almost in that kind of ratio relationship, I think it's important to realize is that as the dollar weakens, it has that positive effect across risk assets, stocks, but also a lot of metals and things like that. Um, it's also interesting to go back to emerging markets, people hear the EEM, because basically EEM, um, Jeremy Grantham has been putting out notes recently. The guy's a famous long-term value investor, and he's been saying that there's significant value in emerging markets, in their markets, and I think that's kind of interesting. And another thing is, we see all kinds of fiscal troubles in France and England. So the thing is, if you want to be long global stocks, you're going to end up with a lot. Your traditional long global means Europe and Japan. That's your big meat and potatoes. The thing though is that Europe is not in a great spot. Japan, I don't even know what to make of Japan exactly, because they're also in a massively indebted situation. So looking out in some ways, if you don't want to be long, if you kind of see weakness in the dollar, and then you look to global and you look at France with this huge deficit problem and a political paralysis, you say, I don't know about Europe, but then suddenly emerging markets, a lot of them have faster population growth. A lot of them don't have as much debt now because they've been basically, kind of sidelined for so long that they haven't leveraged up. Like I said, EEM is below where it was in 21. It's below where it was back in 2007. So from a value perspective here with the weakening dollar, I think this is something that people are going to be focused on, that they seem to be focused on. There is evidence of it. Look over here on our platform and we go to your key ETFs. We look here on like the kind of 21-day performance. What do we see? We see gold outperforming metals. Wait a second. I'm going to add there, EEM. I'm sorry. Here it is. So you can see 21-day. Look at EEM, 7%, SPY's up 5%, and EFA is up 1.5%. So you can see here on most of these time frames, the emerging markets are outperforming. They're up 27% year to date, which is twice the gain of the S&P. And in the last month or so, they're outperforming global, which is basically global is developed markets, which is basically Europe, and that's EFA is essentially Europe plus Japan. EEM is like Brazil and Russia. Well, not Russia anymore, but Brazil, India, South Africa, which has gold. So I mean, that's kind of your different Latin American countries and some Asian countries as well mixed in there. And that is really where the money is flowing. And I think this is an important theme to realize, because there is not probably a huge amount of exposure in Latin America. And I can tell you just emerging markets overall. One of the things I see when I look at options trading is I can tell you that a lot of these instruments that used to trade 200,000 contracts a day back when I was working for the Nigerians in like 2007, back in like 2010, and I was, work with some of those guys that followed options trading aggressively back in my previous life. Basically, we saw so much options activity in the emerging market things and in global stuff, and these things are just very quiet now, and that tells you that there's not a lot of froth or speculation or momentum in them, and that may actually mean that there's a lot of room for people to migrate back into these emerging market global things. So I just think it's important to realize. I know it's something it's not on a lot of people's radar, but you know what? Maybe that's the reason why it's kind of outperforming. Um, okay, now I thought this was interesting. This shows a quick like 15-minute chart of gold versus treasuries. I thought it was interesting to see. This is the Fed meeting right here. Is a 15-minute chart of GLD and TLT, and look at how basically after the Fed meeting, gold fell, and then so did bonds, but gold immediately recovered and bonds have continued lower. So this kind of shows that if you're Joe Schmo in central bank of whatever country, or you're some long-term asset manager trying to protect your purchasing power, and you look out and you look at, I can buy treasuries or I can buy gold. they're increasingly, this is kind of an example of long-term sort of money of reserve allocation, continues to see this move into gold. And I think it's really interesting to kind of see this divergence after the Fed meeting. It shows that people who were waiting to buy gold did, and basically there's not a lot of people waiting to buy treasury bonds. So I think that's kind of interesting as well. It's also interesting to look at the Fed here. I don't have it in front of me, but if you actually look, I mean, tomorrow, if you look down here at the week ahead, Jerome Powell speaks tomorrow at 12:35, and that could be a big one. But today, Alberto, I think is his name, Musalem. I think he's at the St. Louis Fed. He was hawkish. Bostic in Atlanta was hawkish. Beth Hammock, I think she's in Cleveland. She was hawkish. And then Stephen Miran, the new gentleman who joined the Board of Governors, who Trump put in, and he's filling in for the term that expires in February, but he's in there now. He was massively dovish, and he was the guy who won at 50 basis points last week. So I think that's just interesting, but it does kind of show that for now, the Fed is, I think, not really the most, it's not the clearest thing, and I think that in some ways, the weakness in the dollar, in my overall view, is actually the most important thing right now. This weakness in the dollar, people probably look at and they see, well, no matter what, there is this kind of 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 weakness in the dollar, and that is more of a dominant story right now. And unless Powell is massively kind of hawkish or really surprises, we could actually see this trend that was established may actually just to kind of extend, because this may be where the path of least resistance lies, regardless of exactly what Powell says tomorrow, unless he's a totally aberrationally hawkish, comment. And the thing to remember is he's not around after the spring anyway. So the market is looking out and they're seeing a Fed that is going to be politically forced into a more dovish direction. And that's what's really, kind of hitting the dollar. I also think it's important to realize it's very interesting. The American Association of Individual Investors, AAII, last week, for the first time since 2009, we basically saw 40% bullish. I think it was 41 bullish, 41% bearish in their weekly survey. For the first time since 2009, we saw more than 40% on either side, bullish and bearish camp, a total split in the survey. That's just interesting. You can make it whatever you want, but I think it does kind of it highlights something. My sense is that there's a lot of people who just keep looking out the world and wanting to be bearish, and then it doesn't work, and that is also the wall of worry. So from my perspective, that's more consistent with the wall of worry that may kind of talk about a market with the potential to keep melting higher. And Julian Emanuel at Evercore yesterday, he said that the S&P could go to 9,000 next year if FOMO really takes hold. And when you look at the market overall here, there is an argument potentially, here we are at the S&P, that maybe we actually do see FOMO is taking hold as we speak. One of the things I'm pointing out here is the way that essentially we have this uptrend and this line, and this market could be steepening to the upside. And this is what happens when things are running and they don't pull back, is that the ascent can steepen, and it seems to be happening here. So I think that this is something that we cannot look past. So there's a weekly chart of the S&P. Another thing I want to mention today, Goldman raised their S&P target to 7,200. I'm not sure what it was before, but they're raising their target. They're citing strong earnings. And the last little news item that jumped out to me today that I wanted to mention is that the NFIB, there's an interesting article on MarketWatch that emphasized that the amount of hiring is the worst since sometime in 2020. No, it wasn't the amount of hiring. It was the amount of the proportion or the percentage of open jobs that are unfilled. So basically showing the hiring capacity of small businesses is now at the lowest level since 2020. This is a MarketWatch article that was parsing the NFIB report last week. But overall, I think it shows the same thing, kind of limping employment. But again, that means the Fed is potentially more in that dovish direction. So here we are at the S&P, getting into the main charts we look at. And from my perspective here on the weekly chart, this kind of gives us a real confirmation of what we've seen. We see just steadily higher lows on this here. And if you look overall, look at this, we can count these weeks up here, but look, I'm going to do my little counter here on TradingView. And if you look, you could say essentially in the last 14 bars, we've had 11 green bars. So you get like basically in the last 13 weeks, we have in the last 14 weeks, we have 11 positive. So basically you get a negative You run for 3 to 4 weeks, and then you have a red pause, run to 3 or 4 weeks and a red pause. But even then, I want to kind of point this out. I thought this was interesting to look at it from that perspective. Look on the daily chart; it's a little bit more interesting here. And then I thought it was interesting that MACD now is kind of ramping back up. This is like I'm zooming in on MACD here, and what you can really see is that essentially there was a period of time here where it was just languishing, and now it's actually ramping again, and that is also a sign that this market might be getting more kind of I won't say euphoric, but not a lot of selling. The other thing that's interesting here is to see that RSI is up in an overbought condition. And, RSI can go up and get overbought and then basically barely pull back in this kind of environment. If you look back to where the market was in like 1996, 95, it looked like this. All right. Now, just zooming in on the price action, what was very important to me was that last week we basically held the high from September 10th, which was right around 65.50. So I thought that was interesting. Um, and old support, old resistance, new support. And from my view here, it's interesting to see us kind of we opened red and we turned green quickly. And I think now, if there's any level that maybe people are going to be looking for retest, it could even be something down, like 60, something around kind of 66.30. I'm not really sure at this point, really even what level matters most when you're in this kind of uncharted territory. It's like the S&P. Sometimes you have to kind of let things play out over time, and maybe at some point in a week or two, we've had like 3 or 4 green weeks. Maybe we get that kind of that red week, and then maybe the level to test is something like something around here. Maybe this is what we end up kind of seeing, but maybe it doesn't happen for like a week and a half. Maybe things drift higher and then come back down. But at this point, I'm not sure where to draw the line. Now, if we go back over here on the weekly and look at the Qs, essentially we have a very similar sort of situation. I don't see anything on this chart that informs us in terms of significant levels to look for. From my view here, when something has this kind of position, you get 1 or 2 down days, down like 1%. Look at it on the daily, and basically buyers often appear. So from my perspective here, the Qs are just kind of confirming. But in some ways, if the Qs are bullish like this, then in some ways the opportunities maybe in things like advanced micro or something, if you're looking for some kind of individual names in the stock picking market, kind of flipping more to the individual names. But that's the Qs. The Dow here is following a similar sort of trajectory. And from my view, also, I don't see any levels that are especially meaningful, but it is just kind of consistent with shallow pullbacks, like, or where people may be stepping in. Now, the Russell is kind of stuck at this level from 2021, and people are going to be looking for a breakout here. And, from my perspective, this is something that maybe we need Powell tomorrow to kind of, give an all clear. I'm not really sure what to think of the Russell here. And from my perspective, the Russell in some ways is everyone wants to be really bullish on the Russell. A lot of this is now coming from biotech, but I think at this point overall, with the Russell being a domestic sort of thing and the global outperforming the emerging markets and stuff, people may want to be kind of balancing. Do we want the Russell or do we want to be thinking about emerging markets? This is not broken out. It's stuck at this level where it's been at recently, and I'm not really sure what to make of this. It's been up now for about 6, 8 weeks. And, from my perspective here, if I'm looking for any sort of area that may be an opportunity, we have just a little inside week here. I don't really have a good view of this. My sense would be that what people might want is to have some kind of, just pull back closer down, kind of around like 2,400. In my view, this looks like there's been a fair bit I can see more on the daily chart of this around 2,400. We've had some activity there really since like September 5th. And that might simply be more of a sort of area where there's opportunity. It's not to say we'll get a pullback to that level, but that might be a spot where people are more active. Now, the 10-year treasury yield, I think, is interesting because here it is with this outside week here. And I remain in the mindset that the upside in this, from my perspective, is the greater risk overall. A lot of people might not agree with that, but from my view, we have this fiscal situation that increasingly is kind of problematic. We did see yields move higher after the Fed cut rates, which is kind of like we saw back here in September. Now, of course, that was a 50 basis point move. But if people get the sense that the Fed is going to be complacent about inflation, this does have some upside risk. So, from my view here, holding 4%, people might see this oozing higher. So I want to just kind of point this out that this is something to me that makes me, it could make us wary about things like housing, small caps, banks, things like that. If we start to see real estate, a lot of things that are interest rate sensitive could have trouble if this does continue higher. And technically, when we look at it here, there are reasons to think that it maybe it's putting in these higher weekly lows here. I mean, held this level from back here in March. So I do want to mention that even with the Fed cutting rates. So the Fed has cut rates since September of 24, and the 10 year is higher. Back here it was at, you know, call it like, 3 and 3/4, and now it's over 4, despite, I guess, 75 basis points of rate cuts. So the trend is kind of asserting itself here. Now, DXY, I just got to very quickly mention the dollar index. I'm just going to show you this again because it was just on my list. But basically, like I said, this is one where I think you look at this long consolidation here, and you can see there's different levels here. I mean, we could easily move this line like over here, kind of, and see that we've really consolidated under here for a while. So I think, like I said, this to me is, I think, an important one to look at. Look at it on a longer term chart. You can essentially see here that we've made some lower highs here since 1985 and a lower high since 2001, and here we have a lower high since 2022. So from my perspective here, it's not too hard to see, a series of lower highs on this chart, and then to see a fair bit of space to the downside, and see from a risk reward perspective that we continue to have the lower highs, but then space to the downside, which could mean that that space to the downside is where the market is, where prices want to go and fill. Now, materials here, XLB, this has all kinds of weird stuff going on. There's some increasing evidence that China wants to compete with some of the key chemical companies. This sector now, in my view, is completely baffling, and I think it is stuck in this range and it's not breaking out. Now, there might be some potential to see if it can hold this level from back here, but from my view here, things like materials are probably a pretty risky bet because not a massively strong economy, and China increasingly competing in a lot of supply chain disruptions. It involved ethylene or something. If you actually look, there's an article, I believe, on Reuters today. They basically said the Chinese were going to increase some of the chemical production. So apparently, the Chinese have been importing a bunch of American chemicals to use in their different machine manufacturing that actually were inputs into products they exported back to the United States. So China has been buying some things from us, like soybeans and chemicals, that to kind of offset and recycle some of the dollars they get from their surplus with us. Well, now if they say, hey, maybe we don't want to be, you're going to be putting tariffs on us. Well, they've not been buying soybeans, and now it looks like they're moving away from some of our chemicals, and that is not great for something like XLB. Some of these metals are interesting, but XLB is increasingly a kind of chemical and packaging industry sector, and less of a metal sector. So I just wanted to point that out about XLB. It is stuck here, and that is something that could potentially see getting sucked back down deeper into that range. Communications XLC also just remains in a very clear sort of uptrend. I'm going to move this support up to this level here, the weekly high or the weekly close from 2 weeks ago, which was a close at 117.35. So I think that's actually kind of, people might be looking just for a little bit of nudging down toward that. But here we are as a little inside week. And from my perspective, people might not even see much potential for much of a move below that. We might actually see something closer to kind of 118 as about as good as it gets. When we get into these kind of short-term movements, the weekly levels in some ways, just looking here at the low, I think at this point things have been holding recent lows. So I'm gonna actually move it up there to, I think, 118. I'm sorry, the low was 117.78. That's where I'm gonna put it. Okay. That was XLC Communications. XLE, there's an article today that said Reuters. I think it was Reuters, but I think it was actually not just a Reuters exclusive. I think it was from the Iraqi government saying they're increasing their oil exports. Remains trapped here. And from my view here, oil is in an area where people, may see this potential for this to fill kind of down here on the weekly chart. Um, at this point, with the dollar really weak, it may not happen all that quickly, but it continues to make the lower highs and it has that space lower. Financials here, financials and industrials are also in a spot where they have not broken out. in the, financials here. And from my view, I think people may still actually see some risk of this chopping down toward kind of essentially this low, which was around 52.84. From my view here, this might be the spot where people want to actually see something of a kind of slam down and test. But the failure to really break out when the overall S&P, like we've been saying, this has been a shift back to growth, the large growth. We've been saying this since the beginning of last week, and it is what's been happening. The financials had a little bit of a bounce last week, but they are limping and starting to underperform here. XLI is in a similar boat. I mean, this trend line I'm going to take away now because I think what really matters is this line up here that we haven't gotten through. So I want to point that out at XLI industrial. Same thing, sideways movement, no breakout. These could stagger, and then when a pullback does come, they might be the place where the selling hits hardest. XLK here at this point, essentially very similar to the Nasdaq. From my view here, um, I mean, maybe a pullback to that recent high. That the high of last week is the first place to be looking for support on the XLK. XLP, however, we've kind of talked about how this had that potential. Being a safety play is not a very safe thing in a bullish market, and this is the consumer staples XLP. And here it is. We had talked about this potential to break this support at 80 and move down towards 76, and that's exactly what's happening. So from my view here, this is I'm going to just take away this line because it doesn't even matter anymore. But this is now a range 76 to 84, and at this point it's just melting lower. So consumer staples here in a typical spot, um, and I think that you know this is given the risk environment and everything else. I think this is a sector that's expensive, and people probably just see less overall opportunity in this sort of area right now. XLRE real estate also just kind of limping here. This is likely to follow interest rates, but from my perspective, this is one where we've been saying that we want to see if it can kind of break out through 43. It has not. This might also be something where if we start to see some acceleration to the upside in yields, that this could actually start to suffer. It did not get the breakout in any way. We were saying that people might want to watch to see if it happens, but it hasn't happened. Now, utilities here, we had mentioned how it held this 83, and that basically was a confirmational resistance new support. From my view here, this has some potential space to the upside. We're seeing some of the kind of nuclear energy AI stocks like CEG today doing relatively well. VST, Vistra, yep, outperforming. TLN, a relatively new name as well. All these are the kind of AI related names. NRG Energy. This is something that people might want to look at a little bit. But utilities here seem to have the confirmation of, essentially confirming above the old highs. And from my view here, people may look for this to break out to move up above 86. The only risk with this also is if we do see yields move much higher, that is something here with this that might hold these back. But they do have an interesting sort of thing happening here with their overall kind of secular strength and the AI energy demand. XLV healthcare here. It's interesting to see this new level emerge at kind of 135.76. The XLV here, people may actually look for this to move back up toward 144. So I think this is interesting to see how it's trying to hold this level. And it's been interesting to look at the biotechs as well, because the biotechs are really outperforming here. And the nightmare in healthcare may have kind of run its course for now. This is an area that still has obviously secularly a lot of strength because of the aging population and other things like that. Also, in a limping economy, less cyclical growth, healthcare has a natural benefit from that. So a lot of bad news has now kind of appeared in healthcare, and it may be kind of holding a level here that is kind of emerging, and that could be a surprising, potentially positive thing in XLV. XLY here has broken out, and people might want to just look for a test from my view, right around kind of the low of last week, which was around the high of the previous week. Um, Let's see, that low last week was 239. So essentially right around 239. It was the low last week, and then the week before it was essentially the high. So people might want to just look to see if it holds that level. And when you have something like this that's broken out and it's just kind of sitting, this is sort of thing when it might just kind of sit here for a couple of days, not even get down to that 239 level, maybe just kind of linger near it, slightly above it. And then after maybe another day or two down, the continuation occurs. I don't have it on this chart, but the 8-day exponential moving average on this one might also be catching up. So those are the main things I want to be covering today. We are not doing market trends this week. We'll be back in a week for State of the Market on Monday. the 29th. Hope everyone has a great week, and I'll see you then. Take care.